The concern for me is that if China stops for 2 or 3 months, do other central banks follow them? Now, in May, when the numbers came out, we saw lots of central banks buying gold, no impact. But of course, at that time, Turkey and Venezuela and Saudi Arabia, they didn't know that China wasn't buying. So now we haven't got the full numbers for June yet. I think that'll be important to see, are other central banks still buying? So that, to me, if China stops buying for, let's say, 6 months, then the risk is that other central banks decide, well, let's just also hold back and wait for lower prices because they know something we don't.
Gold prices continue to surge, pushing back above $2,400 an ounce and approaching new record highs, despite China's central bank not officially increasing its gold reserves for the past 2 months. This resilience in the gold market underscores a broader trend of growing demand from various sources, as noted by industry experts. Adrian Day, president of Adrian Day Asset Management, identifies central bank purchases as the primary driver of recent gold demand. While China had been the leading buyer until its recent pause in May and June, other countries have continued to acquire gold, maintaining the momentum in the market. This trend is further supported by the 2024 Central Bank Gold Reserve Survey, which reveals that 29% of central bank respondents intend to increase their gold reserves in the next 12 months, the highest level observed since the survey's inception in 2018. According to a World Gold Council analyst, India's central bank is believed to have increased its gold reserves by the most in almost 2 years last month. Day points out that Chinese investors represent the second major factor driving gold demand. Concerns about the Chinese banking system, economic stability, and potential currency devaluation have led many to seek gold as a haven. With the real estate market posing risks and cryptocurrencies banned, gold has emerged as an attractive option for Chinese savers. This sentiment is reflected in the significant increase in Chinese investments in gold ETFs over the past 6 months. Furthermore, Day highlights substantial buying from wealthy individuals and families, particularly in the Middle East and Asia. This diverse range of buyers, each with their own motivations, has contributed to today's robust gold market. Please tune in for our exploration of Adrian Day's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
It seems to me that the main driver by far has been central bank buying. That's been the main driver, and of the central bank buying up until the last 2 months, it's been China. China has been the main buyer of gold, but even when China's paused, both in May and June, so they bought no gold in May and June, other countries were still buying. So central bank buying has been the main driver, not just this year, but for the last 18 months, really. The second major factor in the buying has frankly just been Chinese investors. And these are people who are afraid of their banking system. They're nervous about a Chinese economy, a stimulus coming in, and they're nervous, frankly, about the possibility of a yuan devaluation. I don't think that's going to happen, but so they don't want money in the banking system, which they're nervous about. They don't want to put money in real estate, which, of course, is a traditional haven for Chinese, but for obvious reasons, because half the Chinese real estate companies are going bankrupt. They're not allowed to buy crypto, and so that leaves gold, which, of course, Chinese people like anyway. I mean, we're painting with a very broad brush here, but, this is not a stretch for Chinese savers to invest in gold. And you can see that if you look at the numbers from the Shanghai Gold and Silver Gold Exchange, the withdrawals from the Shanghai Exchange, but also from the imports into Hong Kong. These are numbers that are reported. So you can see that. So that's a very large driver. Offsetting that, of course, is the fact that ETFs, and we might talk about this later, but gold ETFs, other than Asian ETFs, but North American and European gold bullion ETFs have had withdrawals, and pretty steady withdrawals all year, which is really, in a way, astonishing, but we can talk about that if you want. So offsetting that. So when you look at the numbers and add them all up, there's still a gap. Who else? Someone else is buying. And the buying, I think, is coming from sophisticated, wealthy individuals and families in the Middle East, in Asia, but also, to some extent, in North America and Europe. And that buying is physical, over the counter. So it's not, each trade is not reported, but in aggregate you can see that's a pretty big number. And I think the interesting thing to me is that everybody's buying, the buyers, the central banks, the Chinese, the wealthy individuals, putting them into buckets, they're buying for reasons that have nothing much to do macroeconomic environment, which is, high interest rates, strong dollar, relatively low and declining inflation, apparently. I mean, I'm not saying I agree with these narratives, but this is what the headlines would tell us. A strong stock market, which is competition for gold, and I said a strong dollar, didn't I? So those factors are typically a bad economic environment for gold. And I think that's why individuals in the US are pulling money out of gold ETFs, why investors in Europe are pulling money out of ETFs. But the people that are buying for reasons other than the macroeconomic environment. Central banks, of course, are buying because of a weaponization of the dollar. Chinese buyers we've already talked about. And the sort of third group, what I'm calling the wealthy, insightful, I think they're buying not because of a macroeconomic environment, because they're worried about the fragility of the system. They're worried about something much, much bigger than, whether we're going to have a recession or rates are going to go down or inflation is going to go up.
While the softening inflation data may dampen interest in gold, the precious metals performance tells a different story. The market's strength comes even as the People's Bank of China, a significant player in the gold market, has paused its gold purchases for the second consecutive month in June, according to the World Gold Council. This development has raised some concerns among investors, as noted by a research analyst at UBS. However, Adrian Day offers a more nuanced perspective. Day points out that although China has temporarily withdrawn from gold purchases, other central banks are filling the void. He highlights recent World Gold Council reports showing significant gold acquisitions by Poland and India in June, underscoring the persistent demand from official sectors. Let's get back to the interview.
I really didn't think, and I had said this in some interviews earlier in the year, I honestly didn't think, I wasn't surprised that China decided to pause. We've had the gold price go from, they started buying when gold was a little, recent buying, little under 2,000, and they were buying all the way up to 2,300. Not a surprise that they decided to just stand back and let things settle down. I'm not concerned as it affects China per se. The concern for me is that if China stops for 2 or 3 months, do other central banks follow them? Now, in May, when the numbers came out, we saw lots of central banks buying gold, no impact. But of course, at that time, Turkey and Venezuela and Saudi Arabia, they didn't know that China wasn't buying. So now we haven't got the full numbers for June yet. I think that'll be important to see, are other central banks still buying? So that, to me, if China stops buying for, let's say, 6 months, then the risk is that other central banks decide, well, let's just also hold back and wait for lower prices because they know something we don't. And the Eastern, on balance, all ETFs are getting outflows, but the Eastern ones are getting inflows, but the net, it's still outflows. I think, frankly, it's a matter of the macroeconomic environment. Which investors in the U.S., whether they're small institutions, whether they're individuals, family offices, this just does not seem like the good environment to be buying gold. And the stock market is still doing well. Now, you and I think everybody and his dog knows that NVIDIA is driving 50% of the stock market this year, and we know that 4 or 5 stocks are driving 70% of the S&P this year. This is not a healthy market. This is the worst market breadth I have ever seen. You've got a market high, and you've got more individual stocks making 52-week lows than 52-week highs. That's a very, very worrying sign. But nonetheless, the market is going up. So why do I need gold? I think that's the narrative. It's not surprising that it's taking a long time for a recession to occur. When you think that we've really had 12 years of excessively easy money and low interest rates, and 3 years, the 2 years of COVID, with just unbelievably excessive, an abundance of money thrown into the economy. And so it's natural that, therefore, it takes longer for all of that to weed out of the economy till we get to a recession. I think there's two things. One is the employment that you mentioned, and the headline numbers like new jobs creation and like job layoffs and new unemployment claims and the unemployment number itself. They are just inching towards the direction of recession. But the reality is that I think those numbers in many ways are flawed. And if you look under the hood, the employment picture is a lot worse. The new jobs creation and the unemployment rate would suggest. I mean, first of all, new jobs creation, you've got two reports, both from Bureau of Labor Statistics, two reports, the payrolls report and the household survey, which are going in diametrically opposite directions. And even the Bureau of Labor Statistics, this is not, an independent, it's certainly not sort of Adrian Day. The Bureau of Labor Statistics itself is showing a loss of over 1 million full-time private sector jobs last year. That is private sector. I mean, the government is still the main driver of new jobs. That is not a healthy jobs picture.
As gold prices remain resilient despite China's pause in buying, how might the interplay between central bank policies, investor sentiment, and economic uncertainties shape the precious metals market in the coming months? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.